The materials sector in the U.S. recently broke out to a fresh all-time high, and in fact, it has advanced for 10 weeks in a row. That win streak is also a record, but our next guest just downgraded that sector to underweight. It's part of portfolio moves that he's making as we head into a new quarter. Let's bring in Scott Chronert. He's Managing Director of U.S. Equity Strategy at Citi. Scott, thanks so much for joining us. You know, we love a contrarian take, and I guess being bullish materials was a bit of a contrarian take for a while, but now that it's got the hot hand, why are you calling it quits on the rally?
You know, it's really interesting. There are so many parts of the economic sensitive or cyclical side of the S&P 500 that we've seen the price action since the November timeframe kick in pretty aggressively on, let's call it soft landing euphoria, if you will. But in many cases, the fundamentals have not yet inflected to the positive in a way that would support the price action. The materials sector is an example of this, where, as you point out, we've had a very good run to start the year. But when we look at the earnings progression and the margin progression, they've been pointing lower for some time now. Consensus expectations are for an improvement going forward, but we prefer to be in a wait and see mode. We think we need some time for the fundamentals to more aggressively grow into the price action.
And another one of your contrarian takes, but it's a little bit more nuanced. I also noted that you kind of moved tech, let's call it's not overweight, but you did downgrade to underweight the hardware part of tech, which would include a stock like Apple. Talk to me about the nuances and the choosiness that you're now displaying in the tech sector.
So it's a really good point and a good question to answer. I'd say the way we're looking at this is there's no doubt that the generative AI frenzy is kind of kicked in and benefiting many areas of tech. We've, for a while now, preferred the software industry group within tech, and we've also had a pretty persistent hold on semis. So those are our two preferred vehicles. When you look at the hardware component, much like my reference on materials, what we've seen is pretty decent price action of late, but the fundamentals here, either from a traditional earnings, cash flow, sales perspective, or from a margin perspective, have been really kind of flattish, right? So whereas we're seeing very defined fundamental improvement and growth trajectories unfolding for software and semis, we're not seeing that in hardware, okay? In addition, many of these hardware companies have a lesser direct connectivity to the generative AI play. And so what we're doing is suggesting a bit of a pause on that part of tech, which in aggregate pulls our sector rating down to a market weight from a long-standing overweight.
Well, let's talk about your target. I mean, how that plays out in the broad market, because obviously, you know, AI is so dominant for the whole market. You note that you're through your 5,100 target for the year, right? Just in the first 3 months. What are you going to do with that target? Is it more likely to go up or revise down?
You know, it's very interesting. What we've been arguing for some time now, and when we put the target out back in early December, it was fairly aggressive versus most, and we were getting called out on that level of aggressiveness. It's always been predicated in a very solid earnings growth rebound for the S&P this year. After a couple of years of flattish earnings trends, we're projecting 10% earnings growth this year. That gets us to a 245 estimate. We give it a 21 times PE, which gets to our 5,100. At the same time, we've also ventured a bull scenario for the S&P of 5,700 that's predicated on 260 of earnings and a 22 times multiple on that. My point here is that we need to see a more aggressive uptick in the fundamentals via earnings per share than we're already modeling. We don't have line of sight to that at this point. And so our preference, to my earlier point, is give this market room to digest the gains, the very strong gains off of the November lows. We think that probably unfolds as we go through the Q1 reporting period and then beyond. As we get to the middle part of the year and we get to that Fed pivot point, I think we'll be able to turn the page on our earnings growth scenarios and look potentially more more constructively at the earnings picture as we head into 2025.
What about some of those softer data points that you look at? You guys are known for your sentiment indicators, that panic euphoria model. What is that telling you?
Well, it's a really good question. It flipped into euphoria on Friday. And what we've been arguing is that usually is a more cautionary signal regarding the one-year forward outlook for the S&P. We combine it with what we call a fair value model for the S&P, and that the market has been running it at a valuation that's above the high end of our fair value model. The combination of the two is giving us a little bit of a pause, and is one more reason why we're comfortable holding with our 5,100 target for now. But again, under the surface here, what I just want to emphasize is that we are quite constructive on the fundamental picture for the S&P 500 grouping of companies. It's just a question of we've run a pretty hard, in our view, mostly ahead of the fundamentals near term. So again, the euphoria reading, the fair value work is telling us to be prepared for a digestive phase ahead.
Yeah, the sectors that you like, consumer, software, as you mentioned, banks, which we'll hear from next week as earnings season kicks off. What do you make of the fact that value stocks, as measured by the S&P 500 Value Index, outperformed last month? Do you think that's a head fake, or?
No, what we've been arguing, I mentioned this earlier, is we've been arguing for this growth and cyclical barbell for many months now, going back to last summer. And, as of Friday, we're starting to shift our narrative here. The narrative is evolving. We're allowing for more room for defensive parts of the market to kick in. But what I really want to emphasize here, which is specifically to your point, is that what we're seeing is a pickup in the relative performance and the fundamental traction for many of what we would call those areas of the market that are more sensitive to shorter term interest rates. So we think under the surface that the market is beginning to anticipate that gradual peaking of Fed hawkishness, which has been for the better part of 2 years in the making, and the beneficiaries of lower short-term rates are in our mind starting to set up pretty well. That's going to include the banks within financials. It's going to include consumer discretionary. Think of auto financing, home financing as well. It's going to include areas such as utilities, which we upgraded from an underweight to a market weight, potentially even real estate. So what we're suggesting here is that this move down the value path, we think, is definitely underway. It's been happening for the better part of 6 weeks now. But we think what it really is about is the market starting to position for the more direct beneficiaries of this gradual peaking in the Fed hawkish narrative.